And we are live. Welcome to this fun live stream from MicroConf, TinySeed, about how will the Silicon Valley Bank collapse affect startups. I'm Rob Walling, co-founder of MicroConf and TinySeed, host of your favorite podcast about startups called Startup to the Rest of Us. And this gentleman joining me from Austin, Texas, South by Southwest, is Einar Vollset. Einar, intro yourself.
Yes, my name is Einar Vollset. I am a partner and co-founder at TinySeed.
And we received over the weekend, since Friday, I've received a lot of outreach asking our opinions on, to be honest, before yesterday afternoon, when essentially, it was announced that depositors would be made whole as needed by the Federal Reserve. We got a lot of questions about what should I do next? How should I react? I think the conversation today is both, it's different than it would have been 24 hours ago before that happened, right? But it's also, there's still a lot of questions. We're going to talk a little bit about what happened. I think most people probably know that, so we'll skip through it. Talk about maybe a little bit of our own experience dealing with it, and then talk about, looking ahead, talk about, there's a lot of conversation around, was it a bailout or not, as well as advice and actions to take moving forward to kind of ensure your financial safety. I think the one question that we had in the outline is why are we uniquely suited to talk about this? What do you think, Einar?
Just because a shit ton of our money was stuck in the SVB and we were panicking, maybe. So we dug into specifically what, and we saw we're connected to, obviously a lot of this was tied to VCs and, we are VCs, and we saw a lot of the behind the scenes machinations going down over the weekend and last week. So we sort of lived it. We definitely had funds above 250, per EIN in SVB, and we over the weekend there was a lot of panic about, what does this mean? What do we do now? What are the contingency plans? And partly why did this happen?
Right. And it's interesting when if I didn't have money on the line. It just, when you have money on the line, it makes you really dig into things and learn about them and follow it closely and really get into the details,
For sure.
So obviously, disclaimer, this is not financial or legal advice at all. It's just two people talking on the internet about some stuff that
two opinionated dudes. Yeah.
Yeah, exactly. If you have questions, we already have a few questions that have come in on Twitter, via YouTube, and via MicroConf Connect, but feel free to ask them in the YouTube chat, and producer Ron will put them in our doc. So to kick us off, Einar, 2-minute recap, what happened and why did this happen so fast? And really, what was the sequence of events? Why did SVB fail?
So this is basically one of the first social networking bank run collapse, effectively, is what happened. So the technical reason that kicked it off in the first place is kind of boring, and I think a lot of people don't fully understand it. They sort of, the headlines are they took super risky bets and then they lost all their money and now they're getting bailed out, which sort of not really true. First of all, nobody, an equity holder or employee at SVB, is getting bailed out. So that's a big change. But fundamentally, what happened was, so VCs. Silicon Valley Bank was the largest bank for VCs and startups. And as everyone knows, in 2020 and 2021, a lot of these startups and VCs raised a lot of money. And most of the time they put their money in SVB for structural reasons, basically. It was the default gold standard bank to put your money in. So from SVB's perspective, what they then did, the mistake that triggered this whole thing was, usually what they do with these deposits are they don't gamble them on super risky assets. They're just looking to get some return on deposits. And so what they used to be doing was buying government-backed short duration, so a year-long bonds, and they were doing that. But then in 2020 or 2021, for whatever reason, they started to, instead of buying bonds that were 1-year expiration, they started to buy them that were doing 10-year expiration. So they were basically,
don't know, the longer your duration of your bond, if interest rates change, when interest rates go up, your bond values drop.
Yeah. Right? So the challenge became basically they had 10-year bonds with 1.2 6% interest in an interest rate environment where, now you can get 4.5%, 5% guaranteed from the feds. So that was the problem they had. Now, there was no, I mean, again, like how risky were they? They were still government backed. There was nothing wrong here. And basically the difference was they had some of these, like what we call AFS, available for sale, and some they were planning to hold to maturity. So if you don't lose the money, even if you have a low interest rate, even though the value of the bond goes down, you don't actually lose any money as long as you plan to hold it to maturity. The challenge is, they basically didn't. What they decided to do was to crystallize that loss, and in order so they could free up capital and buy higher performing assets. That's fundamentally what I think they were trying to do. The problem became that they did that the day after they announced this. The day so what they did was they did that, and then they said, okay, in order to make sure that we're already within the sort of like federal requirements for safety, but in order to stay even more on the side of this, we're going to raise $2.5 billion ish of equity sale. Basically, the challenge was in part is that they announced this the day after Silvergate went under. So Silvergate was this crypto bank, and then it's basically a PR disaster from their end. They basically decided to put that out there that this was happening. They'd crystallized this loss, and they're raising $2.5 billion with the help of Goldman Sachs, and like General Atlantic was putting $500 million in. The challenge was that, well, they came out the day after another bank failed with like, hey, we need to, like, the impression was we need to raise $2.5 billion, and we've only raised 500 million. And so that's what sort of triggered people to start being like, hey, what happened? And I truly believe this, I think sort of VCs caused this bank run is my view. So some high profile VCs then started advising their portfolio companies that they should take their cash out. Now, was this prudent?
One I heard was Peter Thiel. The first one I saw
was the first one, but certainly other VCs too. Instead of what I think they should have done, which is like, basically get on a call and be like, hey, let's not induce a bank run here. They basically induced a bank run, telling everybody to yank their money out. And so when that started, what are you going to do? Like, you're going to fast like a flash crash of deposits. And really what would happen then is like, the problem is now in order to fund all that stuff, you have to start selling things that you weren't planning to sell.
SVB meaning.
Yeah,
because they're not liquid, right? They have $200 billion of assets, but only a small percentage of that is liquid at any time. That's what a run on the bank is a bunch of people saying, I need my money right away. I need 100 billion of that. And it's like, we don't have that in cash, right?
Exactly. And actually, like, even when they got shut down on Friday morning in a Pacific time, they had more than $50 billion in assets in excess of deposits. So this wasn't really something where, they took this huge risks, and then, they just crashed and everyone ran. Really, like, I think if a small handful, a dozen or half a dozen VCs had gotten together and been like, okay, let's show a united front in support of SVB, I think SVB still would have been around.
Yeah. And so as of Friday, we were calculating, it's like, okay, FDIC insurance is $250,000. And when we do a capital call for our funds, because we invest in bootstrapped SaaS companies, we get literally millions of dollars into bank accounts. And so what do that's, uninsured by FDIC. And so we're strategizing, like, how does this play out? And then that essentially was assuaged yesterday afternoon when the Federal Reserve said, we're going to cover it, right? That they have a fund. They said, but what they said is, we're going to backstop it. We have this 25 billion already in this something fund. I forget what it's called. And we're going to backstop it if needed, but we don't even expect to need to touch it. Yeah. Right? That's what they said.
Fundamentally. Yeah. So there's no, and I think this must be very clear. Like, there's no taxpayer money going out here. No. This is not like the government handing cash to, VCs who took a bunch of risk. This is just basically the federal guaranteeing deposits, but the actual money, like, there'll be no money coming from taxpayers to any of the depositors. It's just they needed to do this, and you can see it on the Monday morning, like what happened with all the bank stock this morning. This is even after all these things were guaranteed. Like, there would have been an enormous run on any bank that wasn't like the top 4 banks. We would have had, like, I talked to several people in real estate, for example, who basically were saying, like, I got $100 million across 8 regional banks. we have a plan Monday morning, 8 a.m. We're going to wire everything to JP Morgan. And that would have happened across the country for sure.
It would have been catastrophic.
Oh, yeah.
Basically cause a bunch of run on additional banks because this is a contagion, right?
Yeah.
So that's the thing I wanted to say. I mean, the whole weekend, I was like, I'm hoping the Fed steps in because again, this is not a bailout like 2008, 2009, where banks themselves, the shareholders of a bank, the equity owners, everybody, the CEOs and all that, the bank was given money to stay solvent and to stay in business. It was a taxpayer handout. Now, it turns out the US government actually made money on all that. Yeah. Did you know that? Through the warrants and whatever else, and the loans, they got paid back. But that's aside. This is very different from this. Silicon Valley Bank is done. It went to zero. If you owned all the equity holders, like the shareholders in SVB, they get nothing. The thing that the Fed is stepping in to do, and as you said, not taxpayer money, is to make startups. And these are like, look, people say, oh, startups in Silicon Valley and this and that, but like TinySeed startups, there's like, we funded 105 companies and like 3 of them are in Silicon Valley. These are like in the Midwest, these are all over the world, and they're just small businesses that you
It's honestly like some of the stuff come through there. People are like, why would you only super wealthy people stake more than 250,000? I'm like, yeah, but okay. So how does this work? We have 100+ investors and we're going to invest in 30, 40 companies. What are we supposed to do? Like, put the money in 50 different bank accounts? Is that the prudent thing to do? I mean, it's a nightmare of accounting basically to do that. So we didn't. So yeah, I think people really misunderstand what's going on in terms of how it's doing it.
That's the thing. The $250,000 FDIC limit, even for individuals, okay, maybe, but like when you run a business of any size, you have a cash balance. I mean, you have 30 employees, 40 employees, like your payroll, that's like 2 months of pay, 3 months of payroll, whatever. It's just not that much. That's the problem is with businesses that this amount of, that amount of insurance.
Yeah. And the notion, I mean, so fundamentally what's going to happen now, and you're seeing that with Mercury and Brex and all the stuff, it's like basically you'll have software layers on top that'll spread the risk across, 30 banks at a time, and that's one way to go there. Now, here's my view of this. If you do that, then you get, I don't know, say $5 million, $10 million worth of FDIC insurance. I don't see why that's like, as somebody who decides to stick money in a bank, what moral hazard did I, did I take by taking cash and putting in a bank account? I don't think you really understand. You want a system where like basically all of US industry thinks that, there's no single bank that can take more than 250,000. That's a nightmare scenario for all of the US industrial base. It's just not tenable as an approach. And basically, I think if it hadn't have rescued, I think pretty much all banks other than like the top 4 most likely would have gone out of business. So now you would have 4 banks that are way too big to fail. You could never let them fail, which arguably maybe you should have done in 2008. But now they're so big because nobody else is going to trust like putting money in a local regional bank. Like, why would you? It doesn't make any sense to do so because that money could be gone.
The risk. Yeah. And also, I mean, there's a huge risk to, I think you had said, boy, we might be hitting a startup winter where just the market, the bottom drops out. No one's spending money to buy companies. No one's investing money. Like if this hadn't been, backstopped yesterday. So we have tons of questions coming in. I want to get to those. Hopefully that's been a good overview for folks. Obviously feeling very much relieved today. And I believe we're supposed to receive funds today, right? It should already be in our account in terms of.
Well, yeah, what happened apparently, so famously, the Silicon Valley Bank web interface has always been atrocious. So I'm not surprised, but what we're hearing is that basically all the funds are available as normal. You're just encouraged to, as soon as you can, move those money into a different bank account. So a lot of people are like scrambling to get set up with a different bank account, basically, so they can move it out somewhere else.
Right. And
so that's what's going on pretty much across the.
We've been unable to log in thus far because their servers are down, but it is what it is. So first question, Martin in the TinySeed Slack asks, I'd love to get your thoughts on this tweet from Modest Proposal 1 on Twitter. And this is a tweet. The piece I haven't read yet, but I'm very interested in is how does the tech ecosystem change over time without SVB? The cost and ease of doing business has to be going up meaningfully. Everything from fundraising to lines of credit. I don't think the ramifications of this are very well understood. I have my own thoughts, but what are your thoughts?
Yeah, I agree 100% with that. I think like basically Silicon Valley Bank was, pretty much one of the only banking, like true banks that like would do things like provide venture debt and lines of credit to startups. And I think I think the most likely outcome of this is that, and like, obviously we all know that like with the war in Ukraine and whatnot, the fundraising environment's gotten significantly harder, in 2022 and going into 23. And I think a lot of the time, like startups that were reasonably well capitalized, they were planning but maybe will struggle to raise in this environment. We're planning to rely on venture debt and like debt options. And I think that's become significantly harder / impossible pretty much overnight over the weekend. And so I think what's most likely to happen is that, I think a lot of people were predicting like because people had raised so much money and all this stuff, like there's going to be like a slow moving car crash with startups going under. I think if anything, this will accelerate that, because the people who can't raise, had to raise, but were planning on relying on venture debt, are now going to struggle to find those things. So I think it'll accelerate death in the more traditional venture environment. I think that's probably true. And also I think in general, like, I think this will significantly impact the appetite for people to invest money and lend money. So I think like things will slow down and freeze. And I think that's, does some of the same stuff that the Fed is doing with the increasing the rate. So I wouldn't be surprised if there's going to be another meeting in next week about the Fed raise, and everyone's saying, is it going to be 25 basis points or 50? I wouldn't be surprised if it's nothing now because of this.
Because of the fear around it. Yeah, I think you're right. I think startups that rely on funding, and especially venture debt, are going to see it, because SVB was a huge provider of venture debt. We don't have time to really define what that is, but just assume it's loans, plus they get an option to buy some part of your company called warrants.
They also had a pretty significant portfolio of startup shares.
Yeah.
And so I think because of these warrants and things like that they had, and those are assets now to creditors. And I think, it'll put downward pressure on secondary prices for some of these, privately listed companies if they're required to be sold.
The other interesting thing is I have several friends who were unable to get a mortgage because they are a startup founder, and you start a company, and even if you've raised money and you have tons of money in the bank and you're taking, a salary, you go to a standard bank and they don't understand it. Same thing being a venture capitalist, which, it sounds like a first world problem, but it's like, no, I can't get money to buy a house. No one will lend me money. SVB understood that. They would ask about your fund and this and that. So that's going to be maybe not as broad of an issue, but certainly an impact. Our next question is from Dave in MicroConf Connect. And he asks, I just raised a friends and family seed round and deposited it into SVB last week. It is over. What timing? Sorry, Dave. And it's over the $250,000 FDIC limit. It was definitely a stressful weekend. So it's stuff like this, like friends and family. It's not a bunch of billionaires. It's like his friends and family giving him money to grow a startup, to create jobs, and he could have lost a chunk of money. His question is, the startup world understands the contagion and payroll issues that would have ensued if the government didn't backstop uninsured deposits. However, public perception, which you can already see on Twitter, is that this is just another bailout for wealthy people. How do you parse this out? And what are your thoughts? I guess we kind of already answered this a bit. Do you have any additional thoughts on this?
I think this is sort of the fallout to a degree from the change in sentiment about tech. So I think broadly, some of the main press pieces has turned pretty hostile to tech since 2012, 2014. It feels like, it feels like a missed opportunity from tech, although we saw, with the herd mentality this week that I don't know how much of a community there really is. But fundamentally, I think this is the backlash of some pretty high-profile VCs being Class A assholes, and sort of like, the joke is like, there's no atheists on a foxhole and no libertarians during a bank run. Like I think some of that is playing out. There's been a lot of like huffing and puffing from pretty big asshole VCs who have like skewed people's perception of what this means in the economy. And so I think there's a lot of sort of schadenfreude, as it were, when it comes to seeing, it's like, let's go and get those fuckers. But fundamentally, here's the thing, like those class A assholes, they're fine. Like, do you think they have cash stuck in SVB? No, most of the time. They're invested all over. You know, it's really the smaller players that are getting hurt for this. So yeah, I think that's part of the reflection. Like part of the reflection is like tech has just been starting to be portrayed as this boogeyman, and that's sort of playing out in people's perceptions of what happened, for sure.
Yeah, and it's interesting that tech it's like Facebook and Google and Uber, they're not, I mean, even if they're banking at SVB at all, they're not under any danger of this. They have money all over the place, right? It really is the smaller players, the TinySeed companies, the MicroConf companies, the 40, 50, 60 person startups. I mean, we know that like the vast majority of jobs in the US specifically are created by companies under 50 employees, you know?
Yeah.
And that's what a lot of these funds, that's where a lot of these funds were from. Next question. Yeah, so Kevin in MicroConf Connect asks, what can startups do to reduce potential fragility in light of SVB? So as we move forward, what are some steps that we can be thinking about? So
yeah, I mean, I think, so here's my thing. I suspect that we'll get to a point where like the FDIC insurance will be higher, which I think makes sense, because it's like, what's the value of not doing that? And you can say, oh, well, then the government is backing they take all the risk and stuff. You know, there are already regulations in place around what the level of risk you have to take, you're allowed to take with the money. And so, okay, if you increase the limit, now the banks need to put more money into the FDIC fund to backstop more money. But I think that'll come. In the intermediate, you'll definitely see things like, like we're moving to Mercury, the startup bank, and full disclosure, the founder is a friend of mine. But they just today announced they have like a 3 million FDIC limit, because what they're doing is behind the scenes is they take the money and then they spread it across multiple banks for everybody. And they also like are offering like insured, basically treasury management products. So this will be things that like sweeps into get government guaranteed bonds, that sort of thing. So I sort of hope that the FDIC limit will be raised, because it doesn't add any business value to spend like a lot of time and effort to just move money around, like between different institutions and in and out of overnight funds and all this crap. Like that's not actually valuable stuff.
No,
it's just something that you sort of have to do now. And like, I think that's sort of for startups, that's what I would do. If you have significant cash, I mean, we did this too with TinySeed. We would overnight, they would be swept into, government funds and government insured, funds. The challenge was the bank got shut down on Friday during the business day. So I was joking on Friday. I was like, it'd be better if you'd shut it down like a couple hours before, because then our funds would have been with the feds.
Right.
So I think that's what will happen. People will start switching to banks, and banks will start offering products that share the risk across. So you're effectively, no matter what happens with the FDIC limit, you're getting a higher FDIC limit for your funds.
Right. Yeah. I like the idea, with our personal funds, I've always had multiple banks, even if one of them is like a brokerage or a retirement thing, they have, an ATM and you can move money in and out. So I've always had that ability. I've never done that with any business I've started. I just never thought it was necessary. So these days I would have a spare bank account. And even if you only have 1 month of payroll, or 2 weeks or just some amount of money that you can stash away, that because the odds of it all going away are relatively low. It can happen, but they're relatively low. But the odds of you not having any cash for a week, it is totally possible, right? Of everything being locked up for a number of reasons. We're going to take more questions, but as a reminder, if you like these types of reactions to current events and more videos about growing your startup, make sure to like this video and subscribe to the channel. Next question is from Trevor in MicroConf Connect. I'm curious why VCs did not encourage their companies to take out private deposit insurance for amounts over $250,000, or, as we just said, to diversify their holdings across several banks, since this was a known risk factor. Was SVB just part of the good old boys network, so VCs quietly ignored the risk, or was there another reason? I will say, I'll just address the moving it around to other banks, because it's a huge pain in the ass and it's a bunch of wasted labor. This does not grow our economy for me to have my ops person spending hours a month moving crap around. And To be honest,
on the insurance side too, there's no panacea there, because then it's like, all right, now I have to pay for this to store money in there for presumably a short amount of time. And most of the time we have less, we don't have a ton of money in TinySeed because we call the money in and then it gets spread out again once it's deployed. And so now if you take FDIC insurance on top of that, you got to pay for it. Okay, but now are you, moral hazard? Are you going to do your due diligence on the insurance company? How do you know the insurance company? How do you know if they don't go under? Where did they store their bank? Like it's a sort of a rabbit hole of just one thing after another. If you can't trust the system, if you need to make every piece of the financial system in the US, like all the inherent trust that exists there, if you need to make that explicit and charge for it, you're going to add a significant friction to the economic growth in the United States. So I don't know that you want to do that. Like, it wasn't like a good old boys network. It was just, look at any business with more than 4 employees. They will have been in this situation in the last 12 months where they had more than $250,000 in a single bank account. They just had to. Like, it's almost impossible not to do it.
Yeah, and do we want startups spending their time and money building a better product, finding more customers, than creating the jobs and hiring people? Or do I want them spending time screwing around with their bank account? Like the red tape it's just not what we want to be doing. Kent on YouTube asks, do you think this will affect seed funding as much as it will mature fundraising cycles?
I think so, because I think what's happening is the challenge is, like, a lot of VCs, they have some folks now that maybe they thought, okay, we know they can't raise, but now they also can't tap debt markets. I think a lot of funds will now be earmarked at least towards propping up existing bets. So yeah, I think it'll have an impact on how much money flows into pre-seed and seed. I think in general, it has a chilling effect on the things. I think a lot of people will now be spending their time, like LPs, investors, angels, will now spend a lot of their time and effort moving money around and putting it in different places and, worrying about, shit, is this bank going to blow up? Is this thing going to go away? Instead of investing. I think that's true. And I think it'll definitely impact seed investing and pre-seed investing.
The next, we only have 2 questions left. And Chase Lee basically asked, do you think this affects fundraising for startups, or does everything reset to where it was 2 weeks ago?
No,
it sounds like you feel
it was already bad 2 weeks ago. It's even worse today.
I think so. And I wonder how long that'll last. That's the thing. You just don't know, right? There's an institutional memory or a cultural memory of this. And will it take, 2 months? Will it take 6 months? Does it take a year? What happens? Yeah. And the other interesting thing is, if there is another regional bank failure, God forbid, it's that regional banks do fail over the years.
Oh,
right?
Yeah.
They just fail. Yeah. Now all of them are going to be reported on. Every single
one. Because this is only it's high profile, it's a big bank, but also pretty much nobody, the only instance I could find where any depositors ever had lost any money was in the IndyMac failure. There's been hundreds and hundreds of failures where people don't lose their deposits. It's not common. And actually, in SVB, I actually don't think depositors would have lost any money in the long term, even for this situation. I just wouldn't have happened. I think
SVB had the assets to cover it. It just would have taken a while to sort it out.
A lot of time, and a shit ton of other banks would have gone under.
Yep. All right. Last question, and then we'll wrap. And as a reminder, if you like this type of video, as well as learning how to build and grow your own startup, make sure to like it and subscribe to the channel. Jay on YouTube asks, sorry for the tinfoil hat question. Do either of you get a gut feeling that there was something bigger going on here, aka someone driving the bank run intentionally for their own gain?
So there's rumors that basically some of the same people who were encouraging folks to withdraw, their portfolio companies to withdraw, had short positions on the bank. I haven't heard anything other than rumors on that. So I don't know.
I wonder if there will be an if there's rumors, then I bet the Fed, somebody in the, where the Attorney General's office has to be.
Yeah, because that's not legal. And so there is that. But yeah, I hope not, but I wouldn't be super surprised if something like that did happen.
Yep. All right. And that is it for the questions today. Thanks everyone for joining us. We love to do these topical and timely live streams when things like this come up. So final reminder, subscribe to the channel, like the video if you like this kind of stuff. Einar Vollset, thanks so much for taking time out of your day. He's supposed to be at South by Southwest, folks.
I am at South by Southwest. I'm just stuck in the Airbnb doing calls.
Sitting in a hotel room doing a live stream instead. Yeah, it's awesome. It's good to see you, man, and great to see everybody. And we'll see you next time.